Do you like stocks?
Well, I think the environment, as we said in our outlook, is a little more constructive, but only because some of those levels have come down. Yeah. So we've had a bit of softness to start the year.
Just a better entry point.
Yeah, it's a better entry point, precisely.
And where do you think the stock story goes this year? The story has changed so much from January, and we came into the year and it was kind of synchronized global growth and stocks were on a tear. It feels like a very different place mid-year.
Yeah, I think we've still got the synchronised growth, but of course we've had a lot of growth momentum in 2017. In a way, the momentum's gone, so we've seen a lot of the PMIs and things come off the peaks, but they're still at levels that are consistent with pretty good global growth, and it's very coordinated around the world. So, yeah, there's not the positive momentum, but the level still is pretty good.
What within the mix, though, if you take if you peel one of the layers away and you start looking at the sector story, what you're getting, and we've got a chart we can throw up here to show you this, and you're getting it in both Europe and you're getting it in Japan, is that the cyclical story's fading and the defensive story is coming to the fore. Now, is that an indication that that's got to be an indication that the market's feeling a little bit more nervous just at the fringes?
More nervous because I think you've seen the Fed raise rates and a realisation they are going to continue on this hiking path. So I think it's the market digesting the fact that the Fed will raise rates 3 more times this year. That's certainly our view. And that, yes, you haven't got the same growth momentum, and so therefore you're seeing that pivot. I don't think that's so surprising.
Is that... that's OK, though?
Yeah, it's OK.
You're kind of comfortable with that. I still want to own stocks. I just want to own different stocks. I've got to be a bit more nimble.
Stocks, yeah, you've got to be nimble. Got to remain, you know, in an active type product. But you're still, and you're going to get more single-digit returns. You know, I think people have got very used to seeing these big double-digit returns. It's more a single-digit return kind of environment over the next 12 months or so.
What about volatility? I need to think about volatility in terms of my sort of ratio, my Sharpe ratio, all these kind of things in terms of kind of the risk that I'm taking.
Yeah, precisely. And again, if you think of 2017, the VIX basically was stuck around 10. It was almost a flat line. And then we come into the start of the year and we see this big jump in the VIX. Now, a level around 15 today, we're around 13.5. But a level around 15 is not so unusual. And it's probably consistent with a normalisation that is taking place around the world. Better growth, central banks raising rates or at least removing quantitative easing. We're in a more normal world with some volatility. And again, the VIX at 15 historically is not such a high number. But again, we've just got used to seing these very low vol numbers.
2 words that people keep getting cross with me for using: late cycle.
Late cycle. I don't know why they cross with you. We're certainly in the extended stage of that cycle. Think about how long this growth cycle has been going on for. So, yeah, we're in the late stages. The question is, you know, how much has it been prolonged by the activities of the Trump administration, of course, the fiscal stimulus. So maybe it's a longer cycle, but again, we're still in the later stages.
Have we got, and it's interesting you bring that up, because there's slightly sort of conflicting signals. If I take a look back at the last reporting season, particularly out of US companies, they're spending on CapEx like it's mid-cycle. They're not spending on CapEx like it's late cycle. Is that the Trump effect?
Well, I think some of it, again, remember there was all this trapped cash that was offshore, and these tax changes have enabled that money to come back onshore. So I think, yeah, again, these signals don't always line up perfectly. Everything's not late cycle, but companies have a lot of cash. That cash can now be employed. I think that's encouraging. The tax incentives have helped that process. So they extend the cycle. But of course, like any party that goes on for too long, you know, the after effects of that could be more problematic. I think it's a couple of years away. But don't forget, this is a very pro-cyclical policy at a time when unemployment below 4%, the economy is firing on all cylinders. So it looks like that cycle will be extended. But think about the deficit projections, the debt projections for the US 3, 4, 5 years from now. Those are not going to look so good.